Every year, millions of people open brokerage accounts. For the first time, they deposit their savings. They look at a screen full of ticker symbols, and they do the same thing. They guess, they buy the stock their colleague mentioned at lunch. They buy the company whose product they like. They buy whatever appeared in their social media feed that morning and felt exciting. And then 6 months later, they cannot explain why the stock went down, and they have no framework for deciding whether to hold it or sell it, because they never had a framework to begin with. They were never analyzing. They were always just guessing with extra steps. I spent my entire career trying to solve that problem. My name is Benjamin Graham, and I created the systematic method for analyzing stocks that Warren Buffett, Charlie Munger, and virtually every serious value investor of the last 70 years learned from and built upon today. I am going to teach you that method completely from the beginning, not a simplified version, not a watered-down overview. The actual thinking process I used to evaluate every stock I ever bought. By the end of this, you will have a framework that most professional investors on Wall Street were never formally taught, and you will never guess again before the numbers understand what you are actually buying. Before you look at a single financial figure, before you open a single spreadsheet, I need you to understand something that most stock analysis tutorials skip entirely. When you buy a stock, you are not buying a ticker symbol. You are not buying a chart pattern. You are not buying a story or a trend or a feeling. You are buying a fractional ownership stake in a real living, breathing business. This sounds obvious, but almost no one actually behaves as though it is true. If I told you I wanted to sell you 10% of my neighbor's bakery, you would not ask me what the price did last Tuesday. You would not ask me whether it was trending upward on a chart. You would ask me real questions about a real business. You would ask, how much money does this bakery make every year? Is that number going up or down? How much does it cost to run the bakery? Does it carry debt? If so, how much? Who runs it? And are they competent? What would happen to it if a larger competitor opened across the street? Those are exactly the questions you must ask about every publicly traded company before you put a single dollar into it. The fact that it has a stock price that fluctuates every second should change nothing about the quality of questions you ask. With that foundation established, let us go through the actual analysis. Step by step. Step 1. Understand the business in one paragraph. The very first thing I do when I consider any stock is attempt to write one single paragraph, explaining exactly what this company does, how it makes its money, and why customers choose it over competitors. One paragraph, plain language, no jargon. If I cannot write that paragraph clearly and specifically, I stop immediately. I do not proceed. I do not research further. I do not look at any financial data, because here is the iron rule I followed for 60 years. You must understand the business before you can evaluate the business. If someone hands you financial statements for a company you do not understand, you cannot tell the difference between numbers that are good and numbers that are dangerous. You are reading in a language you do not speak. Warren Buffett calls this the circle of competence. He only invests in businesses he genuinely understands, and he cheerfully ignores everything outside that circle. This is not laziness or limitation. This is wisdom. Your circle of competence right now might be small. That is completely fine. Start with businesses that are simple and familiar to you. A retailer, a restaurant chain, a software company you use every day. Expand your circle slowly through reading and observation, but never invest outside it just because the story sounds exciting. Step 2. Examine the earnings history over 10 years. Once I understand the business, the first financial question I ask is, has this company consistently made money over a long period of time? And I mean a genuinely long period, not last quarter, not last year. I want to see at least 10 years of earnings history. Ideally more. Why 10 years? Because 10 years contains enough time to see how a business behaves during difficulty, during recessions, during industry disruptions, during the kind of unexpected shocks that the world throws at every business eventually. What I am looking for is a specific pattern. I want to see earnings that are positive. In most years, I want to see a general trend upward over time. And most importantly, I want to see how the company performed during the hardest years, a company that earned good profits in 2019 and 2021, but lost enormous amounts of money in 2020, tells me something very different about its underlying resilience than a company that remained modestly profitable, even at the bottom of the crisis. The business that earns steady, reliable, unspectacular profits year after year is almost always a safer and ultimately more rewarding investment than the business that earns extraordinary profits in good years and catastrophic losses in bad ones. Consistency is the signal I am hunting for, because consistency tells me the business has a genuine, durable, competitive advantage. It is not just riding a wave, it is actually good at what it does. How to find this information? Every publicly traded company is required to file annual reports. You can find these on the company website under Investor Relations or on the SEC website. These reports contain complete historical earnings, data going back years. Read them. Step 3. Look at the balance sheet, and specifically the debt, after I understand the earnings history. I open the balance sheet, and I ask one question immediately. How much debt does this company carry relative to what it owns and what it earns? This is not a complicated calculation, but it is one of the most important. You will ever make a company with very low debt or no debt at all can survive almost anything. A recession can come. An industry can shift. A bad year can arrive, and the company continues. It has no obligation forcing it to pay creditors before it can survive. A company carrying enormous debt is fragile no matter how profitable it appears today, because debt creates a fixed obligation that must be paid regardless of how business conditions change. And when business conditions change, they always change. Eventually, the debt that seemed manageable in good times becomes the instrument of destruction in bad times. I watched this pattern destroy companies in 1929. I watched it destroy companies in 2008. I have watched it destroy companies in every crisis in between. And the mechanics are always identical. The business looks strong until suddenly the debt burden becomes uncarryable, and then it collapses with a speed that shocks everyone who was not paying attention to the balance sheet. The specific ratio I look at is called the debt-to-equity ratio. It measures how much the company has borrowed compared to how much it actually owns. As net assets, a low number tells me the company is financially conservative. A high number tells me I need to understand exactly why and whether it is manageable. As a general principle, I am much more comfortable with companies whose total debt could be fully repaid within 3 to 4 years of current earnings. I become very cautious when that number stretches beyond 5 years, and I will typically avoid entirely when it stretches beyond that. There are exceptions to every rule, but the rule itself will protect you far more often than the exceptions will punish you. Step 4. Calculate the price-to-earnings ratio and compare it to history. Now we arrive at the question of price. And this is where most beginners start their analysis. They are doing it exactly backwards. You must understand the business before you evaluate the price. You must understand the earnings history before the price means anything. You must understand the balance sheet before you can assess whether the price is reasonable. Price without context is noise. Price with context is opportunity. The most basic valuation tool I use is the price-to-earnings ratio, which you will see written as the PE ratio. Everywhere in financial media, the calculation is simple: the current stock price divided by the annual earnings per share. If a stock is trading at $50 and the company earned $5 per share, last year the PE ratio is 10. It is trading at 10 times earnings. What does this number mean? It tells you how much you are paying for each dollar of the company's earnings. Power a PE of 10 means you are paying $10 for every $1 of annual profit. A PE of 30 means you are paying $30 for every $1 of annual profit. Now here is the critical question that most people using this ratio get wrong. They compare the PE ratio of one company to the PE ratio of another completely different company in a completely different industry and draw conclusions from that comparison. This is not entirely useless, but it is far less valuable than the comparison I actually care about. I compare a company's current PE ratio to its own historical PE ratio. If a company has typically traded between 12 and 18 times earnings for the last decade, and today it is trading at 11 times earnings, that is interesting to me. The market is pricing it below its own historical normal. That is worth investigating further. If that same company is today trading at 35 times earnings, the market is pricing it dramatically above its own historical normal, and I need to understand why before I would consider buying it. Very often there is no good reason. It is simply enthusiasm. It is simply the crowd having decided this company is exciting right now. And excitement is not a financial characteristic. It does not appear on the balance sheet, and it always fades. Step 5, the dividend record. I want to know whether this company pays a dividend, and if it does, how consistently it has paid it. This step surprises many beginners who think dividends are an old-fashioned concept for conservative retirees and not relevant to modern investing. They are wrong, and I want to explain precisely why a company that has paid an uninterrupted dividend for 25 or 30 consecutive years is telling you something profound about its financial character. It is telling you that through recessions, through industry disruptions, through management changes, through every kind of difficulty that 25 or 30-year period contained, this company generated enough reliable cash to write a check to its owners every single quarter without interruption. That is an extraordinary statement of financial discipline and durability. I'm not saying companies that do not pay dividends are bad investments. Many excellent businesses reinvest all of their earnings back into growth and create tremendous value doing so. But a long, uninterrupted dividend history is one of the cleanest signals available to me that a business has genuine, durable earning power, and not simply a temporarily impressive run of good results. Step 6. Calculate the intrinsic value and apply the margin of safety. We have now done enough work to attempt the most important calculation in value investing, the intrinsic value. Intrinsic value is my estimate of what this business is genuinely worth, as a business independent of what the stock market says it is worth. Today, there are multiple methods for estimating intrinsic value, and serious investors spend careers refining their approach. But let me give you the foundational logic. I look at the company's average earnings over the last several years to smooth out any unusual good or bad years. I estimate a reasonable expectation of how those earnings might grow over the next decade. Based on the history I have studied, I apply a discount rate that accounts for the time value of money and the risk of being wrong, and I arrive at a number that represents my best estimate of what a rational private buyer would pay for this entire business today. Then I compare that number to the current market price. If my intrinsic value estimate is $100 and the stock is trading at $95, I am not interested. There is no margin of safety. There is no room for my own errors. In estimation, if my intrinsic value estimate is $100 and the stock is trading at $65, now I am genuinely interested because that $35 gap is my margin of safety. It is my protection against the inevitable fact that my estimate could be wrong. It is my buffer against unexpected bad news. It is the difference between an investment and a speculation. The margin of safety is not pessimism. It is the acknowledgement that I am a fallible human being, working with incomplete information about an uncertain future, and I intend to protect myself accordingly. Step 7. Ask the one question that ties everything together. After all of this analysis, after the business description, after the earnings history, after the balance sheet, after the valuation, there is one final question I ask before I make any decision. If this company disappeared from the stock market tomorrow, and I could not watch its price fluctuate ever again, would I still want to own this business at the price I am being asked to pay? If the answer is yes, I have found something worth buying. If the answer is no, then I have discovered that some part of my interest in this stock was really about the price movement and not about the underlying business. And investing based on price movement is speculation. Not investing the outcomes of the two over long periods of time are not even remotely similar. Putting the whole framework together, let me summarize the complete process so you can apply it. Starting today, first, write one clear paragraph explaining what the company does and how it makes money. If you cannot do this, stop here. Second, examine at least 10 years of earnings history. You are looking for consistency and resilience through difficult periods. Third, study the balance sheet with specific attention to debt levels. You want a company that could survive a serious crisis without being destroyed by its obligations. Fourth, calculate the current P/E ratio and compare it to the company's own historical P/E range, not to other companies. Fifth, examine the dividend history. If one exists, a long, uninterrupted record is a powerful signal of genuine financial durability. Sixth, estimate intrinsic value using average earnings and apply a margin of safety of at least 30% below that estimate. Before you will buy, seventh, ask whether you would be comfortable owning this business if the stock market closed tomorrow, and you could not check the price for 5 years if a company passes all 7 of these steps, and the price is right. You have found something genuinely worth owning. If it fails at any step, you move on without regret. Because the market contains thousands of companies and patience costs you nothing, while impatience can cost you everything. The most important thing, I can tell you, analysis is a skill, and like all skills, it improves with practice. The first stock you analyze using this framework will take you a long time, and your conclusions will be uncertain and uncomfortable. That is completely normal. The 10th stock you analyze will go faster, and your confidence in your own judgment will be measurably stronger. The 50th stock you analyze will reveal patterns you could not see. At first, you will begin to recognize the difference between a genuinely excellent business and a merely adequate one. You will begin to feel in a way that is difficult to describe, but unmistakable when something does not look right. Warren Buffett once said that he read the annual reports of thousands of companies in his early career. Most of them he would never buy, but he read them because each one taught him something he could not have learned any other way. That is the commitment that separates the investor from the guesser. Start with one company today, a company whose business you already understand. Apply these 7 steps. Write down your conclusions, keep the record, and review it a year from now. You will be astonished at how much you have learned, and you will never go back to guessing again. That is how you analyze a stock like Benjamin Graham. That is how the intelligent investor thinks.